Welcome to lecture 20 of Financial Risk Management. This lecture would cover the concept of put-call parity. It is a theory that is used to find the intrinsic value of an option. Okay, so towards the contents, we are going to discuss put-call parity. And if you remember, previous lectures we discussed strategies, option strategies. And there we particularly had a discussion in one lecture on protective put and fiduciary call. These two strategies were there that we discussed. Now we will use these two strategies to make a theory, to make a model that would be used to predict or rather to estimate the value of an option. When I say value of an option, what I mean is what should be the price of that option. And by price we mean the premium of that option. So this put-call parity theory, this model would be used to calculate that how much premium should be paid on the call option or how much premium should be paid on the put option in a specific scenario. And then we will try to understand what are the different determinants of option pricing, what are the factors that affect the premium, what are those factors that would increase the premium of an option, and what are those factors that would decrease the premium of an option. So let's start with the idea of pricing an option. We had briefly discussed in previous slide what pricing an option is. Pricing an option means finding the amount that you pay to have the right or the option. And if you remember, to buy a right, what do we pay? We pay premium. So when we say pricing an option, what we mean is we need to find the amount by pricing the option, or not just pricing the option. When we say pricing an asset, what does it mean? Or pricing a stock, what does it mean? It means that we want to find the price, the amount that one would be willing to pay for that asset. So this subject of asset pricing. We have different asset pricing models, and one of those models you would have studied in some of your finance courses, let's say CAPM, Capital Asset Pricing Model. So it is asset pricing model. It is within the name of this model, CAPM, Capital Asset Pricing Model. So what does CAPM do? It tries to find the intrinsic value of the stock. Okay, right. So similarly, in pricing an option, what we are trying to find out, we are trying to find the amount that we should pay for the right, or we should receive for the right. So in simple words, in previous all the discussions, the amount of premium was given. But in real world, how do we come about? How do we decide what premium should we pay or what premium should we receive in regard to financial options? So, or pricing an option means finding the fair value of the agreement. This is again the same thing that we just discussed. Okay, so what put-call parity is? It is a model that was presented by Hans Stoll in 1968 in his paper, The Relationship Between Put and Call Prices. And this model simply looks like this. The price of the stock, which we can denote by S or S naught, plus the price of the put option. So it is, when we say price of the put option, that means the premium of the put option should be equal to the price of call option. When we say price of call option, that means the premium of the call option plus the present value of the exercise price. Right? we would explore these concepts in a while. So combining this is S naught, price of the underlying stock. If you remember, so when if let's say we buy the stock, so we would buy it at this price S naught. And this is the premium of a put option. So if we combine these two things, buying a stock and buying a put option, then you would probably remember it is the strategy of protective put. And price of a call option or premium of a call option, if we buy a call option and at the same time we buy a bond or for the present value of the exercise price, then if you remember, this strategy was the fiduciary call strategy. So this is the cost of this protective put strategy. We buy a stock, we incur this S naught cost. We buy the put option, we incur this premium cost. So this cost is the cost of first strategy that we incur at time 0, at this time period. And this cost, the premium of the call option and the present value of the exercise price that we are going to invest in on risk-free rate is the cost of the second strategy, which is the fiduciary call strategy. So I have just mentioned that this is the protective put strategy and this is the fiduciary call strategy. Now, let me just give you a basic idea, and then we would dive deeper into the understanding of this model. We will try to derive this model and see how this model works. But let me first give you a basic idea. So, what Hans Stoll says in his paper, he says that this protective put strategy and this fiduciary call strategy would produce the same return, the same cash flow. The end result of these two strategies would be same. So if we invest some amount, we would get the same return at the end of the maturity. Now, Hans Stoll says that if their return is same, if the end result is same, then the cost of both the strategies should be equal. And when we say equality, then we use the word of parity. So there should be a parity between the cost of the first strategy, the protective put strategy, and the fiduciary call strategy. And when there is a parity, what we can do is, if we are given three values from this equation, then we can find the missing one. So for example, we know the S naught, we know the price of the call option, we know the present value of strike price, but we need to determine the premium of the put option. Then what we can do is input the values in this formula and find the missing value, right? And what if we are given the S naught, the premium of put option, and the price of the K, exercise price, and we need to find the premium of the call option? Then we can simply put all the given values in this formula and find the missing value, right? So in this way, Hans Stoll proposed that using this specific model, what we can do is we can find the premium of the put option and the premium of the call option. So the basic idea of this model is to find the premium of call or the put option. Okay, so we got the basic idea, but let's derive this model. Let's have a deeper look on into this model. Okay, so let's take an example. Let's say the spot price is 200, strike price is 220. This is our K. This is S naught. The call premium is 10. This is C naught. And the put premium is 5. This is P naught. and risk-free rate is 10% or 0.10. Now, we have two strategies. We have strategy 1 and strategy 2. The first strategy is basically the protective put strategy, and the second strategy is basically the fiduciary call strategy. First, let's have a look at strategy 1, the protective put strategy. Let's assume that we follow protective put strategy. What would we do? We would buy stock at the spot rate of 200 rupees, because currently the market price is 200. So if we are going to buy the stock, we would buy it at 200 rupees. Our cost would be what? It would be 200 rupees. So protective put strategy have two parts. One, we buy the stock or we own the stock, and then we enter into a long put option. So we buy the put option, and what would be the cost of this put option? It would be the premium, put premium. So the total cost of this strategy 1, which is protective put strategy, is 205. What about the cost of fiduciary calls to the second strategy? In second strategy, we buy a call option. If we buy the call option, at this, we are discussing the situation, the cost at this point 0, right? This is the time that we incur the cost, and this is the time that we get some return. So currently the cost of strategy 1 is 205 at this time period, and the cost of strategy 2, if we strategy 2 is fiduciary call, we buy a call option at 10 because the premium of call option is 10, and we invest the present value of K today in some let's say we deposit in some bank account that offers a risk-free rate. Okay, so how do we discount it? Future value divided by 1 plus R is 0.10. We discount it for 1 year. Let's say this we follow this strategy for 1 year. So the present value we get is 200. Right? So combining the cost, so this is cost because we are going to invest this amount at this time period. So again, this would be the cost of the strategy. So 200 plus 10 would be the total cost of this strategy would be 210. Now, strategy 1 cost 205 and strategy 2 cost 210. Now let's take a look at the return of this both this strategy. Now assume we incurred 205 for strategy 1 and 210 at this time period for strategy 2. Now we need to calculate the profit, or we need to calculate the return or the cash back at this time period. So assume that on this time period after 1 year, the future spot price in the market is 250. What would happen to strategy 1? What you would do is, in strategy 1 you had bought a put option, and what do we mean by put option? We are going to sell this asset, and what price did we agree to sell that asset? That was 220. So what would we do? Would we exercise this this put option or not if the market price is 250? Obviously we would not. Why is that so? Instead of selling at 220 agreed upon price, we have the right, we can sell it in the open market, and we would obviously sell it in the open market for a higher price. So we would sell it at 250. So sell in the market and do not exercise the option. This is one part. So the total cash back of this strategy is, now remember, in strategy 1 we owned the asset and we had a put option, but put option is not exercised. We are going to sell that asset in the market, in the open market, for 250. The total cash back of strategy 1 is 250. We get 250. We invested 205. We get 250 at this time period. What about second strategy? Remember, we bought a call option, an option to buy the asset. At what price did we agree? 220. So obviously we would not buy from the open market, because in open market the price is 250. We would buy it from the person with whom we entered into the contract. So let's just say we are speculator and we buy it at 220 and immediately sells it in the open market at 250. So we book the profit of 30 rupees. And if you remember, we had invested 200 rupees in strategy 2 in a bank for risk free. So we would get 220 at 10% because the interest rate was 10%. So 200, the future value of 200 at 10% is 220. So 220 plus the 30 of profit of the call option, we get total cash back of 250. So in a strategy 2, we exercised the call option, and our profit from that call option was 30, and we our investment matured, and we got 220 rupees from that investment, where we invested 200 rupees in the bank account. So our total cash back is 250. Now you would see that let's compare the cost and the return of these two strategies. In strategy 1, the cost is 205 and the return is 250. In strategy 2, cost is 210 but the return is 250. Now you would see that in both the strategies the return is similar, but the cost is different. So any rational investor would want to go for this strategy. Why? Because it costs less and gives us the same return. So when more people would enter into this strategy, what would happen? Its cost would increase, and when more people would not perform this strategy, its cost would decrease. There is a mechanism behind it, but let's ignore it. So somehow its cost would always also become equal, right? Otherwise, one of the strategy would exist and the other wouldn't exist, right? So the cost would become equal. So now now you get an idea that when return of two strategies are equal, their cost must also be equal. So that's how we develop this model, that the price of underlying stock plus the price of the put option, which is the protective put strategy, the return of protective put strategy, we know this from our previous lecture, that the return of protective put strategy is equal to the return of fiduciary call strategy. If their return is equal, then their cost must also be equal. And if their cost is equal, theoretically their cost is also equal. Then we can use this model, where S stands for spot price, P stands for price of the put option, C stands for premium of the call option, and B stands for the present value of the exercise price. Remember, in fiduciary call we had bond, right? So let's move towards an example and see how we can use this model. Now suppose the shares of stock ABC company are selling at 80. This is our S0. A 3 months call option is 85. This is our strike price K. Goes for $6. And what is this? A 3 months call option with a strike price of this goes for this. So this means this is the price of call option. The risk-free rate is 0.5% per month. So if it is 3 months, then that would be 0.5 multiplied by 3. What's the value of 3 months put option? When we say value of 3 months put option, then we are saying that what is the premium of the put option. So we know we can use this model, the put call parity model. If we put the values, then we have 80, which is spot price. We do not know the premium of put option. We know the premium of call option is $6. And the strike price is 85. We need to find the present value of that strike price. So 0.5% multiplied by 3 would give us 0.15%. And if we find the present value, that would be 85 divided by 1.015. We get the present value, it is 3.74. and we add these two values, we get 89. We transfer this one here, so it becomes negative value. The premium is 9.74. So using the put call parity, we have found the premium of this put option. So this is how we use this put call parity theory, put call parity model, to find the premium of an option.